It is the 24th of July 2023. My name is David Hickson, and in today's market update we're going to be taking a look at gold, and I'm also going to be discussing some of the recent developments that I mentioned in last week's market update with regard to the FLD, Hurst's future line of demarcation that he discovered 50 years ago and that we have been working with and refining ever since. So let's take a look at the chart for gold, and if you have been following my previous market update videos about gold or reading our Hurst Cycles Notes newsletter, you will know that gold experienced an important cycle trough either at the end of September last year or possibly, because there were various very close price levels, there were three potential troughs, so it is possible that that very important trough occurred slightly later than September, perhaps even into October. But my preferred analysis is that the 54-month cycle trough formed over here at the end of September. Interesting to note, of course, that stock markets around the world also formed an important cycle trough, as we were discussing in last week's market update. They formed that trough in about the middle of October last year. And there's a very interesting discussion to be had about the correlation between gold and stock markets, which most people assume is always inverted. In other words, when gold moves up, stock markets move down. But the fact that both of these instruments, stock markets and gold, experienced major cycle troughs, probably of 54-month magnitude at about the same time, raises a very interesting question about that inverse correlation, because certainly they have not recently been moving inversely. But that is not what we're going to be discussing in today's video. What we want to take a look at is what has been happening in gold recently. Following the very important 54-month cycle trough at the end of September last year, we experienced a 20-week cycle trough over here at the end of February, or that might even have been in the first few days of March. And following that 20-week cycle trough, you can see I have a bar count over here that has counted 146 bars, or 20.9 weeks since that 20-week cycle trough at the end of February. Now, the average length of a 20-week cycle is 136 bars. That is the average length that Hurst discovered 50 years ago, and it still applies today. And so the suggestion, of course, is that the second 20-week cycle probably should have occurred at least 10 days ago in order to achieve an average length 20-week cycle. Of course, the principle of variation is alive and well, and we know that these cycle wavelengths are constantly changing because of the principle of variation. The Hurst Cycles approach is a very dynamic approach. These cycle wavelengths are constantly changing, and so in order to inform ourselves as to when that next 20-week cycle trough would be expected, we take a look at what we call a nest of lows at the foot of the chart. This is a nest of lows, and here you can see the 20-week cycle circle. The circle is the exact date upon which the next 20-week cycle trough would be expected based on a calculation of the recent wavelength of that cycle. And because of the principle of synchronicity, which tells us that the troughs are synchronized. I should point out, of course, that that principle was discovered by Hurst when analyzing stock markets, and there is yet another discussion to be had about the possibility that gold is influenced by cycles that are synchronized at their peaks. As I've mentioned in previous market update videos about gold, I think it is very useful to consider both a trough analysis and a peak analysis. Why that might be, I cannot say, or at least there isn't time to discuss that in today's video. But for today, we are focusing on the troughs in gold, and we are, of course, assuming that the cycles that are influencing gold are synchronized at their troughs. One of the arguments in favor of that idea is the fact that we have these very neat nests of lows. You can see that the cycle troughs are lining up very, very closely. That does not mean that this is necessarily a good analysis, but it certainly increases our confidence in this analysis. Now, I've been speaking about the second 20-week cycle, but of course that must also be synchronous with a 40-week cycle. And here we have an interesting situation. Here is the circle for the 40-week cycle, which, as you can see, has been displaced to the right, so that it is in fact floating above this 80-day cycle nest of lows. Why does that happen? I'm going to spend a little bit longer explaining that in today's video, because we had a similar situation in last week's video and I rather glossed over the details of that, and we have received a few emails asking why those circles are displaced. So let me explain it quickly. These circles are positioned on the chart by calculating the recent wavelength of the cycle in question. Now, Hurst worked with charts that were printed, and they consisted of 180 bars per chart. Hurst would calculate his recent average for the cycle by looking at the wavelengths of that cycle on that 180 bar chart. That raises the question, of course, how do we calculate the recent average of the 40-week cycle? First of all, it would be pointless trying to calculate that of 180 bars of a daily chart, because you wouldn't even include one entire 40-week cycle. So what I did when designing Sentient Trader is I made the decision that we calculate the recent wavelength of a cycle by either looking back over 6 iterations of that cycle or 180 bars, whichever is greater. And so this 40-week cycle recent wavelength has been calculated by looking back over 6 iterations of the 40-week cycle, a period of about 4.5 years. And so although we call that the recent average wavelength of that cycle, it's not really that recent, is it? Because looking back 4.5 years for a 40-week cycle is fairly far back. And that's why these nests of lows become so important. The shorter cycles are, of course, calculated, or at least their recent average wavelength is calculated over a shorter period of time. When you have a major event happening in the markets, such as an important trough or an important peak forming in the market, and you probably know that this peak over here was an important peak in terms of gold, and this trough over here was also an important trough. When you have a major event like that happening, the cycle wavelengths adjust because their underlying trend, in other words, the pressure of the longer cycles, changes from bullish to bearish or bearish to bullish. That causes a change in the wavelength of the cycle. And so for that reason, we focus on these nests of lows, and when we see a single cycle displaced like this, I don't take it very seriously. I am more interested in the fact that this period of time over here is the most likely time for this trough to form, the 40-week cycle trough. All that this means is that the 40-week cycle is probably currently beating with a much shorter wavelength than it has experienced over the past 4.5 years, and that is to be expected because of the major peak and trough that have formed in this market, which will inevitably cause a change in the wavelength. And so this nest of lows for the next 20-week cycle, and also of course the 40-week cycle, is over here from about the beginning of July until about the end of July. We had a fairly obvious trough over here, and so it seems very likely that this is indeed the 40-week cycle trough. You might ask yourself, why don't I get Sentient Trader to position the 40-week cycle trough there? Well, I could, and if I was going to be looking at more detail in terms of the shorter cycles, the 40-day and the 20-day, then I certainly would. But I'm not going to waste time doing that in today's video. For the purposes of today's video, I'm very happy to simply present this analysis as it is and say that there is very good evidence that the 40-week cycle trough did happen over here. Another thing that I always do when considering whether a particular cycle has formed a trough in the market is I measure the amount of time that has elapsed since the most recent trough in which I have some confidence. And of course I have a good deal of confidence in this 54-month cycle trough over here at the end of October. The average length of the 40-week cycle, discovered by Hurst a very long time ago, was 272 days. 272 days, as you can see, including, of course, weekends, was over here in the last week of June, and that 272 days was about 2 days before the actual trough formed in the market. Again, that increases my confidence that the 40-week cycle trough formed over here. So that is all good and well. I have decided that a 40-week cycle trough has formed in gold. I am therefore obviously expecting price to bounce out of that 40-week cycle, and then of course it will come down into an 80-day cycle trough over here, and then it will bounce up again, and then it will come down again, and it will end up creating an M shape. So all of that you know. But how can we refine our expectation in terms of what this market is going to do? One way of doing that is to plot the composite model line. And here is the composite model line, only including the longer cycles. And let me just slide this over. And you can see that the composite model line is telling us that the 40-week cycle trough possibly still lies ahead of us. However, we have decided that that 40-week cycle trough is in fact behind us. And following that 40-week cycle trough, we're going to get a strong move up. We're going to get a peak. We're going to get price coming down into the 20-week cycle trough over here, expected in about December. Then we're going to get a move up again and then down to create the full M shape. But now I would like to reintroduce you to the FLD. The FLD, as you know, is my favorite tool that Hurst discovered. And so let's start considering what we are expecting in terms of price interacting with this FLD. And this is going to lead me to introduce you to some exciting new ideas in terms of the way in which we can understand the way in which price interacts with the FLD. This is the FLD for the 80-day cycle. Why have I pulled up the FLD for the 80-day cycle? Simply because if this was a trough of the 40-week cycle, which I am convinced it was, then the first interaction that will happen between price and the 80-day FLD will be an A category interaction where price crosses above the 80-day FLD and creates a target to the upside. I will let you calculate that target for yourself. The next thing that is going to happen is that at around about the time of the first 80-day cycle trough, and here is our nest of lows for that 80-day cycle trough, so roundabout over here at the first 80-day cycle, we would expect this FLD to provide support to price in a B and then C category interaction. I'm sure that this idea is familiar to you, and if you are not familiar with this, take a look at our very many videos about the FLD trading strategy and understanding the way in which price interacts with these FLDs. So what is new? What is different about this? For many years I've been speaking about the sequence of interactions, the A through H sequence of interactions that will play out over the next 40-week cycle in the case of an 80-day cycle FLD. But let's just clear the slate for a moment and let's consider what has happened recently. We have witnessed price crossing above the FLD. That FLD provides us with a target. The next interaction that we are expecting is for the FLD to provide support. That gives us a hint as to a different way of considering the FLD, because these FLDs are effectively dynamic support and resistance levels, or if they are not going to be providing support or resistance, they are what we are calling acceleration levels. And so this recent interaction where price crossed up above the FLD is an acceleration level which provides us with a target to the upside. The next thing that will happen is that the FLD will provide us with a form of support. Now, most support and resistance levels, I'm sure you have plotted many of them on your charts. Most support and resistance levels are simple horizontal levels that are drawn on a chart at recent high and low levels. Those are your traditional support and resistance levels. I would like to introduce you to a new kind of support and resistance level, a dynamic support and resistance level, which is in fact simply a different way of looking at the FLD. The fascinating thing about taking this approach is that we have an FLD for each and every cycle in our analysis. So let's add another FLD, the FLD for the 20-week cycle. Now, given the discussion that we have already had about the fact that this is a 40-week cycle trough, the next interaction that we are expecting between price and the 20-week FLD is what kind of an interaction? I'm going to answer that myself. The kind of interaction that we are expecting is for price to cross up above that FLD in what will be labeled an E category interaction. But again, let's forget the labels for the moment. What we are looking at here is not a resistance level, and it is certainly not a support level because it's above price. It is in fact another acceleration level. And so when price crosses above this 20-week FLD, we would expect price to accelerate upwards and then eventually achieve a target generated as a result of that move. And so instead of labeling these interactions for the purpose of today's video, I'm simply going to draw a great big arrow over here indicating an acceleration level. ahead of us. And of course, price has not yet interacted with the 20-week FLD, and it might do so all the way down here. We don't know exactly where it's going to do this, but sometime in the future, it is again going to achieve some acceleration by crossing through the 20-week FLD. Let's add one more FLD to this combination. That is the 40-week FLD. Now we have a different situation, and let me clear this chart, and in fact let me just hide the two shorter ones for a moment. We're going to come back to them. Let's consider what this FLD line is. First of all, let's use our traditional approach of labeling the interaction. What is the first interaction that you would expect between price and the 40-week FLD following a trough that we experienced at the end of last year, which was a 54-month cycle trough? We would, of course, expect the 40-week FLD to provide support to price at around about the time that a 40-week cycle trough forms in the market. Now, I expect that that 40-week cycle trough has already formed, and as you can see, the 40-week FLD was a little bit below the price. However, the fact that price didn't come down all the way to find support at the level of the FLD does not mean that this doesn't work as a support level. It simply means that there is a little more bullishness in the market than might have been expected in a perfectly balanced market. And the reason for that bullishness, in my opinion, is the magnitude of the cycle trough that formed at the end of last year. Of course, we should probably be looking at this 40-week cycle FLD on a weekly chart. So let's switch to a weekly chart quickly, and let's zoom in here and discuss our new understanding of what these FLDs are telling us. First of all, we have a dynamic support level provided by this 40-week FLD over here. And that support level, I call it dynamic because it is, of course, changing with each and every bar, in this case, each and every weekly bar. That 40-week FLD is expected to be providing support at this time. That is very useful information for us because we know that we have a moving support level provided by the 40-week FLD. This 80-day FLD, again we're looking at a weekly chart here, this has provided us with a crossing point or an acceleration point, and price has indeed seemed to cross up above this 80-day FLD, generating a target to the upside. In order to reach that target, it will of course encounter the 20-week FLD. What is it expected to do when it reaches the 20-week FLD? It is again expected to cross above that FLD, and we don't know yet when that is going to happen, but it is expected to cross above it, and when it does so, it will generate another target to the upside. I do hope that you find this new way of looking at the FLD and understanding the interactions between price and the FLD intriguing. It provides us with a very detailed understanding of where price movements are expected to find support or resistance, or where we are expecting prices to keep moving and to generate targets as they cross through the acceleration points of FLDs on the way. So to quickly conclude this video about gold, we already have a target over here somewhere. I haven't calculated it exactly, but you can calculate it for yourself, where price crossed up above the 80-day FLD. We are expecting price to cross above the 20-week FLD, and when it does, it will generate another target. It might, of course, cross at about the same level, in which case we will have the same target, but it is also possible that it will cross at a higher level, thereby generating a higher target. Throughout this move, we are keeping an eye on the 40-week FLD, which is expected to provide support. Of course, at a certain point, we would expect the 40-week cycle FLD to no longer provide support, but in fact to provide us with an acceleration point downwards as price crosses down below it, but that is sometime in the future. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I will be discussing this whole new approach to understanding price interactions with the FLD a great deal in upcoming videos. So I won't be able to answer all of your questions about that in the comments, but stay tuned for more videos about this new approach to understanding the FLD.